Welcome back to the Energy Desk. This week's episode is focusing on the technological and policy trends that are shaping power markets. There's a lot of uncertainty as AI, data centers, and cryptocurrency add new load to the U.S. grid for the first time in almost 15 years. To resolve some of this uncertainty, this week we're talking to Rishi Sahay, who's the VP within a strategy group at Mobius, and Rishi is uniquely qualified to talk about these dynamics. He has over 2 decades of experience working with hydrocarbons and power markets, and before joining Mobius, Rishi was working at Ascend Analytics, leading their renewable and battery storage valuation activities for front-of-the-meter projects. Let's hop in. This is going to be interesting because this week we had an update to something that hit the newswire this summer, which was PJM's capacity auction. It was a record. Capacity prices for the general auction went to just under $270 a megawatt a day, and some of those went to over $440 a megawatt day, which I'll let you get into. But this week we had some criticism over this capacity auction. Really, people were looking at PJM's exclusion of reliability must-run plants and how that maybe discounted or skewed the real price of the auction. And I think that maybe requires a little bit more nuanced commentary, and I think that you are perfectly suited to add that. So when you saw this come through this week, what were some of your initial thoughts?
Yeah, thanks, Alex. Certainly the PJM auction news caught my attention, and a lot of the headlines are very attention-grabbing. Prices are up 833% versus the prior auction. And so certainly prices are way up, and they've set a record, and customer electric bills will be going up. But in certain LDAs, they'll be going up, locational deliverability areas. But last year they were very depressed. And it's not fair to say they've gone up 9x off a kind of normal level. They've hit a new record. Last year was very depressed.
They were at, for context, last year's was just under $29 a megawatt day. This year, $270 a megawatt day. So that, as you said, last year, quite depressed. So skews the outcome here.
But certainly prices are higher, and PJM wants them to be higher because they're very clear about we need more generation coming in. We need more plants to be built, and we want that signal to be there for plants to be built. And essentially they have revised up their load growth expectations materially. I think for 2030, they expect 10% more peak load than they did previously. So that's happening around the country, particularly in areas that are going to see more demand from data centers. And so they see that, look, we've got coal plants retiring. We've got our peak load assumptions are going higher. There's more renewable generation coming in, which is more variable, and coal generation going out, which is steadier. And so they've increased their reserve margin requirements a bit. And the thing that really actually made it a significant difference in these auctions is they reduced, even for gas plants, they reduced ELCCs, or effective load carrying capability estimates. And in Winter Storm Elliott, gas plants weren't able to produce at the levels that everyone was hoping they would. And that has been taken into account in their new projections.
Yeah. And so I guess maybe for listeners who aren't familiar with these ELCCs and how that fits into this PJM auction, really what this is looking at. So in the capacity auction, say you have 100 megawatts of generation capacity. If your ELCC rating is, say, 35%, like it is for onshore wind in 2026, that's really saying that your effective capacity for that auction would be 35 megawatts of capacity, not the 100 megawatts of nameplate wind that you might be able to say otherwise. It's really trying to match up the reliability constraints to each generation resource, how they performed in the last few years. As you said, natural gas, that's starting to come down, reflective of how they performed during Winter Storm Elliott, et cetera. For onshore wind, as I mentioned, in 2026, that is 35%. That's forecast going down to 15% by 2034. Offshore wind is quite a bit higher, 61% for 2026. Solar, you're looking at between 7 and 11% for the next few years. And battery systems, which we'll talk on later, those are a little bit higher. So it's just an interesting discrepancy. You have the variable renewable energies, the LCC ratings are lower, whereas nuclear is at 95, kind of holding steady. coal 84, gas down to 61% this year. And there's variations within each technology as well. But just a headline breakdown. Those ELCC ratings, as the Sierra Club and some of these other groups, they came and they sent that letter to PJM. They're saying, hey, you're excluding these reliability must run plants. That's skewing prices higher. What's your take on the PJM response there to say, is this a cost question or a reliability question? We had this new load growth that you mentioned. So what's the priority here from a generation resource versus maybe what other groups are hoping to see more of?
Yeah, so PJM was very clear about that we feel like we want the price signal to incentivize new generation to come in. And that's exactly what it's doing, because we do have load growing and we have coal retiring and we have some more variable resources coming in. And for those plants that are reliability must run plants, in PJM, they are not required to bid into the capacity auction. They can bid in if they want to. Again, opponents of the higher prices will say, hey, the owners of these plants, if they don't bid into the capacity option, because it's very inelastic structure, prices will clear much higher and they'll get rewarded. They'll make more money on their existing generations that are getting awarded capacity. And that's unfair to the bill payer, the rate payers in these LDAs that will be paying for those capacity payments effectively. But of course, it all comes down to, do you really think PJM needs to incentivize new capacity to come in the long term? Or do you think that we're overpaying existing gas plants or new gas plants that are going to come in with these capacity payments? And I think clearly there is not currently a lot of new dispatchable capacity coming in PJM. And the Vistra CEO on their Q2 earnings call, he commented that, yeah, capacity prices are up, but it's still not. They still only satisfy, I think the number he said was around 40% or less than half of the revenues that you would need to build a plant. So it's not even with these prices much higher, it's not a crystal clear signal, I think, for new builds to come in across the ISO.
Yeah, and it seems like the takeaway that I had at least was that reliability consideration. You're saying, okay, we need to have something that we can count on during winter months is really this reliability constraint for PJM at least. And so far, leaving more room for variable renewable energies, which are dominating the deployment pipeline for most ISOs. I think that maybe there's some swing back to the middle to say, hey, we need to balance this, have more diversified grid. Maybe you have a different take.
No, I think that's exactly right. I think while market structure continues to get more complex, when you had regulated markets, then it was just utilities charging cost plus. Now you've got, deregulated markets and the structures get, more and more complex. It used to be you could look at reserve margin as, hey, if you have only coal and nuclear or something running, you can just divide peak load by the amount of installed capacity you have. But with offshore wind and solar and gas that may not perform as well in the winter, you have to account for reliability. And that's what's happening with the ELCCs, or effective load carrying capabilities. How well can you perform against that peak load hour? And even that's getting more complex. PJM has just switched to a marginal ELCC calculation instead of an average ELCC calculation. If there's a bunch of offshore wind or solar and you're a marginal extra solar farm or offshore wind farm, then your value is also going to be lower than as if you're uncorrelated, if you have production that is uncorrelated with the bulk of the fleet out there, effectively is what they're doing.
Okay. Yeah, it's interesting. I think that kind of is a nice segue too into how these variable renewable energies are trying to reduce their reliability constraints from the intermittent resource itself. So like wind, solar, et cetera. And really that's where batteries are coming into play. I think you have some interesting perspective on this given your background. And I guess maybe could you give us a high level of what you're seeing in longer term trends and how maybe the use of batteries is starting to shift from a historical case of just balancing versus maybe anything new that's coming out with technology advancements?
Sure, yeah. The big picture is that lithium ion cell costs have fallen dramatically since 2010. They're down around 90% from, let's say, $1,200 a kilowatt hour to more like $120. Again, there's That's an approximate number. But so these costs have fallen a lot, and the electric vehicle industry, particularly Tesla, gets a lot of credit for driving the scaling up of production of these batteries. And so we've seen costs fall. And as a result, in various applications, in various markets, batteries are economic at different places on the grid. And actually, it's in PJM in, I think, around the 2017 timeframe when a lot of batteries came in to essentially provide, as you said, grid stabilizing services, ancillary services, such as regulation, frequency regulation, and spin. And batteries, lithium-ion batteries, because they can turn on and off very quickly, they can provide these services far more cheaply than, let's say, a coal plant or a gas plant. And the grid needs to stay at 60 hertz to be very close to that, to be stable at all times. And previously, a coal plant would have to run at less than full capacity and ramp up and ramp down. Battery can do that much more cheaply. And so batteries could come in these markets and really make a lot of money, make great returns. And that drove, I think that's driven a lot of battery deployments over the last 5-10 years. But now we're getting to a point where, these ancillary markets are relatively thin. They're only so big. And so we're talking on the order of a gigawatt in a lot of these ISOs. In Texas, it's bigger. It's maybe closer to 10 gigawatts. But still, we're going to have about 10 gigawatts of batteries online at the end of the year in Texas. So what's happening across the country, in some areas more than others, but batteries are now setting the marginal price for ancillaries more often. And so these ancillary prices have fallen a lot. And batteries can no longer earn a terrific return just being an ancillary as they used to be able to do. And that's good news for consumers, and that to the extent that, for that impact is going to slightly lead to lower electricity bills, right? If you have those ancillary prices are ultimately reflected in electricity bills. But the question for batteries is, okay, what's going to be the longer term drivers now that ancillaries are saturating? And of course, energy arbitrage, as it's called, is the ultimate expression of how batteries can help integrate renewables. Because with solar energy, the sun shines, obviously, sun rises and sets every day. And when it sets, the solar can no longer send electricity to the grid. But if a battery is co-located with the solar, the battery can charge from the solar during the day and then discharge to the grid at night. And in California, we've seen this in a big way. It used to be a lot of utility scale projects would be done without a battery. And now almost none are done without a battery, because the economics of doing one without a battery are much worse now that so much solar has come on that prices are frequently near zero during the day. Right. So batteries are key to integrating, particularly solar. And the question really comes down to economics of when you have like in California, you have what's called a duck curve, where prices are low in the middle of the day. That's the belly of the duck, and then high in the evening hours. Are those spreads enough for batteries to be economic? And so that's in different areas. CAISO and ERCOT are where we've had the most battery deployments. But of course, even in areas right now where the pure market signals are not fantastic for battery economics, like in the Northeast, there are programs being constructed to augment revenues. So there's the index storage credit program in New York. There's the Clean Peak program in Massachusetts. New York has a target of 6 gigawatts of batteries by 2030. Again, authorities really want to encourage the development of batteries around the country. And of course, nationally, we have in the Inflation Reduction Act now a tax credit for standalone batteries, which we didn't have part of the Inflation Reduction Act. I think batteries have a bright future, but it's a very shifting, the mix of their revenues is shifting substantially.
You're right. And to break that down a little bit further, when you're talking about the energy arbitrage for maybe listeners who aren't as familiar with what's going on, really that's just saying, okay, when wind and solar are generating, you have high wind speeds and clear skies, you're going to have cheaper electricity, so you can store that battery or charge that battery up. And then when prices are more expensive later in the day, sun goes down, wind speeds come off, then you're able to put that back into the grid and get a higher dollar amount for that power. Is that kind of a simple enough explanation?
Yep, that's exactly it.
Yeah. And so I guess the other question there that you mentioned, so these duck curves that we're seeing in the California ISO, those have been getting increasingly steep later in the day as solar, comprises more of their generation mix. What are the risks that you maybe are monitoring with those duck curves and really the rate of net load acceleration late in the day, and what that maybe does for these variable renewable energies, but also for maybe traditional dispatchable resources?
Yeah, it's a great question. I think really that's really the key question in terms of as renewables come in, and there's a certain amount of smoothing that batteries can do to their production profile. There's also a cost for baseload generation, like a gas plant that previously could run throughout the day, and then today with a lot of solar, it needs to ramp down when the sun comes up because it's uncompetitive with solar at those during those hours, and then it needs to ramp back up in the evening. And that kind of ramping down and ramping up, some plants aren't really built to do that. Other plants are built to do that. Some are built to run throughout the day. That has a significant cost. And at the same time, we absolutely need baseload thermal generation. The grid cannot be run on just solar and wind and batteries. A lot of ISOs are facing this dilemma of they want to encourage the transition, but they also, of course, do not want to be heading into the territory of not being reliable. And so we see that creep up in different ways. In California, there was Diablo Canyon that for a while certain groups wanted to shut down, and then it was decided, look, this is times 10% of consumption. We need to keep this plant open. If it's relied peaker plants and nice or RMR plants and PJM, it's a similar dilemma where on one hand, we want this thermal fleet to be replaced by cleaner generation. On the other hand, you can't have these plants exit the fleet and not have a reliable substitute.
Right. Yeah. And there's some stuff on that cycling that you were talking about where as they're cycling up, cycling down, that is increasing the stress on those units as well. So the longevity becomes a little bit of an issue. So it'll be interesting to watch how the market has to shift to accommodate the new load curve, the new net load curve that is increasingly becoming duck curves for California, but ERCOT and many others as well. So I think that'll be an interesting dynamic to watch. I think the battery technology side, you have a lot of expectations about solid state and some of these other ion mixes or metals that they're throwing in. Do you have any thoughts on how the state of the industry is changing from, is it a 2-hour, 4-hour, 8-hour battery? What's the lifespan and the life cycle of each of those different systems?
Yeah, great question. Lithium ion is certainly completely dominant in terms of the commercial projects that are storage projects that are interconnecting. And there's, again, good economic reason for that. We mentioned the battery, costs of approximately, call it $120 a kilowatt hour. That's just the battery cell costs. And the lithium ion, with its ability to ramp up and down quickly, can participate in these kind of grid frequency regulation parts of the market and earn a return there, right? It can also for a 2-hour type of profile or 4-hour profile, fits very well with the daily kind of smoothing of solar or wind. But of course, if we want to support the grid more than 2 hours or 4 hours, then you need a different technology, because lithium ion it's never going to support week-long storage or something like that. You just simply have to procure that many more cells. There are longer duration storage technologies out there. The oldest one is pumped hydro, but of course you rely on certain formations for that to be available. There's different batteries out there. There's iron air, there's compressed air, there's water pumped down, pressurized oil wells that comes back up and turns a turbine. So there's a lot of emerging technologies out there, but they are, generally speaking, their commerciality is still, wide-scale commerciality is still some distance away. And some of these technologies, even if you had 20-hour storage, there isn't currently a market structure that is rewarding you for that, right? And there's would be capacity markets in some form, but long story short is a lot of these technologies will only really develop once, or they'll only reach scale once there's a market incentivizing them to do, as what happened with lithium ion batteries.
Right. And I think it's a little bit of an interesting question too, which we see a little bit in Germany. I've talked about this with Zane on previous podcasts, is what happens to battery, hybrid systems. We have maybe solar or wind with battery, with what Germany calls Dunkelflaut. So multiple days of low renewable generation. What's the backstop for that reliability constraint? And in the research that I'm doing, I haven't really come across a good answer to that problem. I think you maybe be closer to the ground with some of that. So I'm curious if maybe you've been seeing some different things on, multiple days or a week with low wind, low solar, and how grid operators are trying to plan for that type of reliability constraint.
Yeah, it's a great question. And honestly, I think no matter how much you look into that right now, there's no answer to that question, because really at the end of the day, you still need you need something that's dispatchable, that can dispatch for weeks. And that is thermal generation. And so a lot of, I think at companies like Ascend, where I worked, a lot of forecasting companies, you're obviously a lot more renewables are going to come in, but for reliability, you need to model what's going to be there in the wings when this kind of Dunkelflaut, when that happens. And it's going to be a thermal plant. And maybe that thermal plant is running hydrogen. Again, that there's a lot of ifs there as well. When will that be cost effective? But today there is no other technology we can name that would at scale replace the thermal fleet.
So yeah, what's your take then on what this ultimately does for maybe the next 5-10 years of thermal generation, specifically really talking about natural gas from a market perspective? And maybe if you have any thoughts on how nuclear's long-term role fits into that as well. I'm sure there's some nuance there. I'm curious what your perspective is on that.
Yeah, great question. So when you look at the interconnection queues, as you mentioned, they are dominated by solar and battery, and then some wind, and there's some gas as well. But gas is much smaller than it used to be. We're talking 5-10 gigawatts a year across the country. And it's unclear. Particularly, we're introducing new rules potentially that would penalize gas plants. There's the CPP, the Clean Power Plant 2.0 rules, that if you're a new gas plant that's built, you need to have CS, carbon capture and storage technology by 2032 that would capture 90% of your emissions, right? And this is also something that there's not any plants currently doing that, or maybe right. There's one. But long story short is, I think for new gas plants to be built, currently the economics they're challenged, and in some ways they're getting more challenged by more renewables coming in, not enabling these plants to produce throughout the day the way they used to. But that being said, at the end of the day, there's a reliability condition that's first and foremost for these ISOs. And I think that's the debate that's being worked out. PJM would like to have higher capacities prices send that signal to bring new gas plants in. I think some ISOs are torn exactly what they know. They want reliability, but they don't know what form of generation it's going to come in. Mm-hmm. And I think that's what all the different ISOs are and states are trying to figure out.
Yeah, it seems like there's a lot of policy uncertainty. I think the CCS point that you had there is a really interesting one. When this summer you have Chevron deference going through the Supreme Court, I think that there's going to be some interesting follow through or knock-on effects from that with some of the EPA regulations that have come out in the past couple of years on, say, natural gas plants. And I wonder what the sticking power of that CCS mandate would be for, say, 2032, especially when it's unproven technology on a commercial scale for the most part. I think there's some small examples that maybe we could pull out, but I think there's quite a bit of uncertainty around that. And on the PJM side, it's interesting to look at what's the retirement's been for PJM for the last few years, resource-wise. I know I'm looking at that. Since 2002, PJM's retired 54 and basically a half gigawatts of coal and gas-fired capacity and over 62 gigawatts of thermal capacity retired. And so I think it's overwhelmingly reducing the reliable generation capacity. And now that capacity signal comes out this year saying, hey, we need to build these new reliable systems. And so I think it's a really interesting trend to watch, because the interconnection queues are just so saturated with wind and solar. The construction timelines for that. Announced capacity differs quite a bit from constructed capacity. You have the transmission constraints that are there. So there's quite a few unknowns. And on the transmission side, I think maybe as a final piece to this, where do you see that going from removing that bottleneck, the transmission bottleneck? How are people trying to solve that problem?
Yeah, it's a great question. There's certain areas that are easy to build or easier to build, and there's certain areas that are very hard to build. And ultimately, when it comes to long term, if we're going to deploy tens and tens of gigawatts of solar and wind in remote areas, that's going to require a lot of new transmission to be built. And that is shown to be extremely difficult. In the kind of over long-term forecasting, I think one has to take a view of what kind of coordination will there be? Will it continue to be this difficult, or will things get easier? But I think the path we're on right now, those difficulties are impacting what ISOs can believe can come in and how reliable it can be over the long term. And in the meantime, we have load growth and we have retiring dispatchable generation. So that all makes for a mix of, generally speaking, higher prices, higher electricity bills. Mm-hmm. We're trying to push out the thermal without the substitute answer in some cases. And right. With electricity markets that have to be balanced at all times, it doesn't you don't want to be risking being short in wholesale markets.
Yeah. I guess as a final takeaway, what would be some of the opportunities or maybe risks that you'd highlight for people listening, whether they're producers, consumers, or just general businesses, economic considerations, anything like that?
Yeah, it's a great question. I would say that on the consumer side, there is obviously a lot of industrial companies, they want to safeguard against rising electricity prices. When prices are low and not moving around much, it's not something you really pay attention to. But let's say you're a producer in West Texas, and over the last year, for sure, if you're exposed to real-time prices, you're seeing some serious movement in your costs. And so I think there are ways we're obviously monitoring forward markets. There's the energy component, there's the ancillary component, and then markets outside of Texas are the capacity component. But what is an effective strategy for reducing the volatility that you're going to see in those costs is something that consumers are asking. And then on the generation side, it really depends what kind of developer you are, what you're looking to build. But same thing there, where there's going to be certain areas where you're having changes in prices during the day because a lot of solar is coming in. You're having more real-time volatility when the sun sets. And you're also having change in how PPAs are structured and how they're priced. And so those are all the things that will really impact your economics if you're solar or battery developer. Really, at the end of the day, we're trying to safeguard economics for both sides of those, both generation and offtake.
Right. Definitely seems like volatility is in the forecast for kind of all ISOs in many ways. Definitely going to be interesting to watch. And thanks for hopping on this week to break this down for us.
Thanks, Alex.
And for listeners, we'll throw in some more research on duct curves and cost of generation, some of the interesting things that we talked about here for you guys to go and listen along and see the data that we're discussing. Thanks for joining us at the Energy Desk. Again, this is a limited series. So if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.